Welcome everyone. Welcome. I'm Emily with the Georgia Center for Nonprofits, and you are here today for Financial Liquidity. We're really excited to bring this program to you from our partners at Mauldin Jenkins. And so we're not going to hold it up anymore. We got a big program, lots of great information. So with that, let me hand it over to Aleisa.
Okay, great. Thank you, Emily. And I'm going to just call up our slides here really quick to get everyone started. Welcome, everyone. I'm Aleisa Howell. I'm the partner in charge of our nonprofit practice for the firm. And we also have Chris Fields with us today. And he is the director over our outsourced accounting services group. So you'll be hearing from Chris very shortly as well. But today we have on the agenda, we wanted to talk about some of the Financial Accounting Standard Board updates and liquidity updates and how those all relate to one another. We have our information here, again, with Mauldin Jenkins, my contact information and Chris's contact information. We encourage you to reach out to us anytime throughout the year. We have a great relationship with the Georgia Center of Nonprofits, and really glad to help this industry. And anytime that we can help answer any questions, feel free to reach out to us. Before we get started, I just wanted to talk just a little bit about Mauldin Jenkins. I know as you were putting in your chat, those of you attending, we see some very familiar faces, and we're glad to have our clients and past clients and such on here. And those new faces, we're very happy to see you. So I wanted to just take a few minutes to talk about Mauldin Jenkins nonprofit practice and the firm itself. And we are a full service accounting firm. So we do have a big specialty in the niche of nonprofits, but we also are a full service firm and service other, any type of entity that you can imagine, full service attestation, tax, and consulting. So if you ever find your needs outside of the nonprofit group for another reason, feel free to reach out to us as well. And then in our nonprofit practice, we specialize, as I mentioned, with all types of nonprofits, nonprofits of the philanthropic nature, associations, organizations receiving federal funding, educational institutions and such. So we do provide services to not only very small, but very large nonprofits. We often do get asked if there's a certain size that we serve, and we just enjoy serving this industry. So we do not limit it to any certain size. And as I mentioned, we do full attestation, which are your audits and reviews and compilations. We have a tax department that services the 990, all the questions related to 990, unrelated business income and such, and then a consulting piece as well that Chris works in, where we do our outsourced accounting work, outsourced CFO work and such, and then in really any types of advisory type services that nonprofits need. And just to get started on the agenda, as I mentioned, I'm going to start off with the FASB updates. Some of those you've probably already worked through if you've already undergone an audit. Some of the new ones talk about functional expenses a little bit, and then we're going to move into liquidity and availability and kind of how that ties into the financial statements with Chris. Emily did mention there's the chat function, so we will be taking questions, and if you can think of any questions, please put those in there and we will be happy to answer those at the end. I'm going to walk through each one of these. We do have implementation dates, but put this slide in to talk about mainly like revenue, grants and contracts and leases, and some of the dates. As you're probably all aware, some of the dates have been extended because of the requirements for COVID this year. So the recently implemented accounting standards update, which is your ASU 2016-14, hopefully all of you have implemented this by now. If you haven't and your nonprofit is currently in the stage of having an audit or review done the first time and haven't had to put together financial statements, I just wanted to briefly mention the phases of this. This new change for nonprofits, of course, the net asset classifications, just really to summarize there, that's where you previously had your old unrestricted, temporarily restricted, and permanently restricted net assets, and went to these new categories of with and without donor restrictions, some changes in endowment disclosures and such. There's also liquidity and availability came with this new standard, and that's really what Chris is going to talk about. He's going to talk about some financial ratios and metrics, but the liquidity and availability, there is a required footnote now in your financial statements, and hopefully we can provide some insight on how to make that. I always say, like a moving target, where it always can be approved each year. And then expenses, this standard required a statement of functional expenses or a footnote that really shows the same information as a statement of functional expenses. So hopefully all of you had the opportunity to work on that, but we're going to help you just fine tune that and have some slides to talk about what it really means to allocate functional expenses. The statement of cash flows really stayed the same, as it allowed the direct or indirect method. I know a lot of nonprofits are still showing the indirect method, however. And then investment return, just to summarize, investment return net of external and direct internal investment expenses, you're no longer really required to disclose, and you just basically net out those expenses. So some of the implementation matters. Just wanted to talk about revenue recognition and the decision process here. And, we have several slides in here just to kind of help you work through it. And just with the interest of today's time, we probably, won't be able to walk through all the different scenarios. But one of the biggest things to think about is, and we have some slides on this, is do you have an exchange or a non-exchange transaction? And as you can see on the slides, the exchange transactions fall into this topic 606. So what I always say to our clients and people that I'm teaching about this is think about it this way, and we'll go through exchange versus non-exchange. But if you fall into that exchange transaction type, you now fall under topic 606 for your guidance on how to recognize revenue. If you're outside of that, and you're a nonprofit organization, you fall into this category of, contributions for nonprofits. And that's really the biggest and best way that I can say to, what you need to really look at first. But in order to do that, there's some different things. And what does that mean? What does an exchange transaction look like versus a non-exchange transaction? I know a lot of you have probably went through this exercise, and it's not always black and white. What that means. But essentially, exchange transactions means a direct or commensurate value to a resource provider, specifies parties, and really providing to the general public. And then your exchange and non-exchange transactions, some of the easiest ways that we try to say is like the contributions. When you're getting a different kind of contribution and you have to decide, and this probably applies to most of you, I know that the revenue recognition for nonprofits and contribution guidance did apply this year, where 606 could be deferred because of COVID. So some of the things to think about is nonprofit revenue recognition decision tree. Is it a non-reciprocal transaction? Apply contribution, non-exchange guidance. So basically, when you get into this contribution guidance, you need to think of, kind of the old way with some new parameters. Is it, you're outside of 606, so you're not following the exchange transaction, but you're following the guidance for non-exchange transactions and contribution guidance. And then you go to say, is there a donor imposed condition or conditions present, a barrier and a right of return must exist? So this is kind of the piece of it that's a little bit different. A lot of us in practice have said it's essentially the same as what it's always been, but there are this right of return idea. I know Chris and I were talking about it earlier. As entities move forward, they may incorporate this language into some of the grant agreements, but you probably don't see this right away in terms of having the exact language in grant agreements and contribution agreements now.
Yeah, it may say, at least it may say, instead of right of return, that exact language, it may say something like, any unspent funds at the end of the grant will be returned to the funder. Will be returned to us if they're writing the grant agreement, something like that.
Yeah, and that's good. And I know we've consulted with a lot of our clients about when they're writing grants or giving out contributions, explicitly using the new language, which that'll take time to get that built into grant agreements going forward. But basically, if there's no conditions, are there restrictions on the purpose, limit, timing, and such? So you see that over on the right-hand side. Then you get into unconditional restricted or unconditional, without donor restrictions. So that's following that same old guidance of your old unrestricted and temporary restricted net assets. Then if you come back to that there are conditions, basically you have a conditional gift or grant or something of that nature. You recognize the revenue when the condition is met. So rather than when it's, given to you, if there is a condition on it, you recognize it when it's met. And, this can get very technical. I know we always say, like, if you need help, send us the grant agreement or a contribution agreement and such, and kind of look at, really what that means. And the reason I'm focusing mostly on conditional versus unconditional contributions is because this is where we see the bulk of it for nonprofit organizations. Unconditional, for a donor imposed condition to exist, as we mentioned, a right of return or release must exist, and the agreement must include a barrier, indicators and examples to help in the determination. So basically the right of return and a barrier. And to determine what a barrier is, a nonprofit will consider indicators which will include but not limited to the following. So that's what we have here on these slides. The inclusion of a measurable performance related barrier or other measurable barrier. Specifics include a specified level of service, specific output or outcomes. Matching is always a great condition, and that really existed previously to this, but if you have like a matching contribution that says, you need to raise $500,000 and then we will match you, $100,000 or $1 million gift, that actually has to take place and be met before you can recognize the revenue in that matching agreement. And to the extent which a stipulation limits discretion by the recipient on the conduct of the activity, basically qualifying expenses, specific protocol. We often say, of course, with like federal funding, this is really, you see that a lot under your grant agreements. I mean, of course, there's all these compliance requirements that have to be met, qualifying expenses, allowable cost, and all those. So generally, there are some different avenues with federal funding, but for the most part, when you have like reimbursement-based expenses under federal funding, those fall into a condition. And that's generally true of how we have treated that even before this new standard came into effect. The extent to which a stipulation is related to the purpose of the agreement excludes administrative or trivial type things. So this is where a lot of the judgment can come into play. Sometimes, there's almost always some sort of reporting type agreements and such, but it's really, the metrics involved with that reporting that you're meeting rather than just a report or something itself. So those are some of the areas there to consider. And some of the new things about contribution disclosures that you want to think about when you're crafting your disclosure, the recipient disclosures. No additional recurring disclosures have been added to the guidance. Guidance in subtopic 958.310 includes disclosures for unconditional and conditional promises to give. And then for conditional promises to give, recipients are required to disclose the total amounts promised and a description of the amount for each group of promises having similar characteristics. And things that you should think about when you're crafting your disclosure, not intended to be a laundry list of disclosures, but you should consider some of the things like key barriers, subject to matching, incurring qualifying expenses, and measurable performance barriers.
Lisa, before we move to the next topic, I thought maybe just to summarize for everyone. So in determining, the kind of revenue recognition model to follow, there are basically three things you want to look at. Number one, is it an exchange transaction or a grant or contribution? Number two, do I have a restricted or unrestricted grant or contribution? And number three, is it a conditional or unconditional contribution? And the answer to each of those tests, if you will, determine how you apply the standard, the accounting standard in the revenue.
Yes. Yeah, that's a really good summary. And then of course you get into, of course, restrictions. The new terminology, of course, is purpose and time restrictions. And that's still your old temporary restricted net assets. But of course, there's disclosure around that as well. So you can have an unconditional gift, but it could still be restricted for specific purposes. So you always want to adhere to those restrictions as well. And then just moving on, I know a lot of you have heard about the new lease standard, and we're not going to spend a lot of time on it today because, but I did want to make sure that you understood the idea behind the lease standard. It was able to be deferred because of COVID, so everybody kind of get an extra year out of it if you needed that. And essentially with the lease standard, you're following this concept of a right to use asset versus the lease payment. So if you think about your old operating leases, you'd have your footnotes in the financial statements that talked about the disclosure of your operating lease and what those payments would look like over the last, the next few years until that lease expired. But now you're actually going to bring those on your financial statements. It can get very complex. I know we've, early implemented for a lot of entities. Each lease, of course, is crafted differently. So I'd encourage you to get your lease agreements ahead of time and kind of working through these things. But we really today just wanted to get you some of the things that you need to think about when looking at your agreements and what you might need to break out or get further clarification on how those leases work. So essentially what you're doing is all those old operating leases, you're bringing a right to use asset valuation on your books and offsetting by the lease payments themselves. So really operating leases in the past were off your balance sheet and you just had disclosures. And that's really what a lot of this new ASU is all about, is bringing those on to the balance sheet. You can see here, this slide is really just talking a little bit about finance leases, operating leases, your FASB, international accounting, and then also GASB if you're relating to any governmental entities that report GASB. And we have some slides here just identifying a lease, the primary determinant for on or off balance sheet determination. So this topic 842, lease contracts, you want to have an identified asset, the right to control the use during the lease term. So if you have that, and these are the things you need to consider, an identified asset that is explicitly or implicitly specified. The supplier has no practical ability to substitute and would not economically benefit from substituting the asset. And then the right to control the use during the lease term, decision-making authority over the use of the asset, and the ability to obtain substantially all economic benefits from the use of the asset. And then separating leases from non-lease components. So some agreements can be very complex, and this is why we're encouraging everyone, of course, and I know a lot of you have already done so, but taking a look at your lease agreements, and then a lot of like I said, the agreements can be very complex, and you can separate a lease component from a non-lease component as well. And there's some information on these slides talking about that. We're not going to spend a lot of time about this today because it does get into very specifics on each one of your lease agreements, but wanted to give you some information about how to do that. Some of the lease target improvements, the board added a project to its technical agenda in July of 2020. The project is intended to address issues on which the board can act because it already has sufficient information from stakeholders. These are some of the things that FASB is talking about. Sales type leases with substantial variable lease payments, remeasurement of lease payments based on reference index or rates, and then reduction of scope in a lease contract. So some of this is expected to be out, hopefully very soon, fourth quarter of 2020. I know that I personally just attended the AICPA conference, and Jeff Mechanic with FASB was giving us an update on some of this information. So we believe this will to come very shortly. And again, these are just some effective dates of the transition. So some of the other things we wanted to talk about today, and like I said, today just kind of wanted to get you very familiar with a lot of these different standards. We do intend on having some more like deeper dives or detailed training on each one of these topics, should you need some detailed information. But a new, the not-for-profit reporting for gifts in kind. The idea behind this is ASU, the Accounting Standards Update 2020-07. The objective of it is to increase the transparency about how contributed non-financial assets, including how they are used and how they are valued through enhancements to presentation and disclosure. The scope includes contributions of non-financial assets, fixed assets, use of fixed assets, materials and supplies, and tangibles and services. So a lot of you probably know when you get those gifts in kind, especially those services, and how do you value those? The biggest thing that we say as auditors, of course, is to remember that the valuation behind those is really the entity, the organization's responsibility. Although most of our donors are very good at providing us a really good estimate of what those valuations are, it still resides with the organization, the responsibility to have the right valuation in the financial statements. The reason FASB has decided this is an important topic is because recently there's been some larger organizations that actually have come under scrutiny because of overinflating the valuations on these, and it ultimately reflects more profitable or better results from financial ratios, which Chris is going to talk about. So one thing to remember, again, for not-for-profits, especially smaller ones, you may rely heavily on some of these gifts in kind, so that it really may be a big piece of your financial statements. Of course, in your financials, it doesn't affect the bottom line because you have the valuation coming in and then the offsetting, expense that you would have paid. But it does affect some of the program and expense ratios, liquidity, and other ratios. The idea behind this, the presentation and disclosure, again, I could give you a lot of different examples, but there's going to be more enhanced disclosure related to how things are valued, separate line item presentation of contributed non-financial assets and the statement of activities apart from contributions of cash or other financial assets. The disaggregation of amounts of contributed non-financial assets received by category in the footnotes, and for each category, these things also are required to be disclosed. So qualitative information about whether contributed non-financial assets were either monetized or utilized during the reporting period. If a nonprofit's policy for monetizing rather than utilizing contributed non-financial assets, a description of any associated donor restrictions, a description of the valuation techniques used. We were talking a little bit earlier, sometimes you have, of course, contributed services, and we have, of course, these have to be professional services. So it's not really changing the scope of what you are allowed to report. but really the idea behind the valuation of it. I know that we have had several examples. It's fairly easy. Like a good example is a lot of us in these organizations have attorneys contributing pro bono time for a service that you would otherwise have to pay for. And you can pretty much, attorneys providing you a rate per hour that would have been charged otherwise. And that's pretty straightforward in terms of those valuations, but it still is the organization's responsibility to make sure that that's in line with nonprofit organizations. Sometimes some of the other non-financial assets related to, I think about a lot of times like works of art that are donated. And I know that Mauldin and Jenkins, we did an entire session once talking about how to get the right valuations on some of these areas. But those types of items, a lot of times the donors will overinflate the valuation and other things. So you really always want to look at that. And now you're going to be required to disclose valuation techniques and such. Effective dates for this. Amendments will be effective for annual periods after June 15th, 2021. The transition retrospective applications required, and then next step, ASU 2020-07 will be issued. We say here in early September, and I think it actually, in fact, we need to update this, has been issued. The next slide, I want to keep everybody on time. We talk about reference rate reform. I won't get a lot into this, but basically, just wanted to bring it out there. It does apply to nonprofits. Basically, in the past, the reference rates, interest rates used to determine related cash flows, the interbank offered rates, IBOR and such was used. And it's moving more towards this accounting relief method where you're going to be able to use new methods to make it a little bit easier and more in line with your actual agreement. So there'll be more to come on that, but just letting you know that that is out there. And then finally, functional expenses. We've talked a lot about functional expenses in the past. With the new ASU, of course, the functional expense statement is required, or also a footnote disclosure that has that same information. And of course, it's tied into directly with your information on the 990 information tax return. There's a program versus management general type statement on the 990. And I always like to mention, because we get a lot of questions as well, that functional expense statement in your financial statements is governed by U.S. generally accepted accounting principles, and the IRS is dictating, that information that's in the IRS form. So you want it to be as close to possible. There may be differences in what you decide to aggregate or disaggregate in your financial statements, but you do want those allocation methodologies to be the same for both sets. And then really just the differences would be what the IRS is requiring versus GAAP requiring. So hopefully a lot of you have had a chance to sort of take a fresh look at your functional expense statements. A lot of the things that Chris is going to be talking about, these ratios are driven off of the functional expense statement and also, again, what's in the 990. So we would say it's an important part of doing these allocations and tracking those, because from the outside donors perspective, it is one of the areas that they probably primarily look at the most. So again, most of you are familiar with having these new standards out there and requiring this allocation to be done. So just wanted to briefly talk about program services related to how that works, and then also supporting services. So in your program services, those are really the activities and results and goods and services being distributed to beneficiaries, customers, or members that fulfill the purpose or mission. So that's the biggest thing to remember. What is a program? If you're trying to fulfill your mission, that goes into program services. And for those of you, if you don't have a good frame of reference. If you haven't worked with a statement of functional expenses, what you're doing is taking what's called the natural classifications of expenses, such as salaries, it could be rent, depreciation expense, true expense categories, and you're required to allocate those over program and supporting type services. So salaries is really the area that you see most primarily, the biggest area that you're allocating. So what you're doing is taking a person's salaries and saying how much of that goes to program versus how much to supporting services. These slides talk about all the different methodologies and assumptions that can be used in allocating functional expenses. Supporting services, again, are your management and general activities, fundraising, membership development activities. One thing I always like to say is don't get stuck with somebody's title. They may have the title of development director or fundraising director, but that person could actually spend a significant amount of time directly on a program. So you always want to do some sort of study to make sure, because it's beneficial to the organization to have the most that you can allocated to program services. As Chris is going to talk about why that's important, donors do look to see, of course, how much of the contributions that they're giving is going directly towards a program versus administrative services. I don't think that's probably a new concept to anyone, but that's just trying to tie it all together, why the functional expense statement was made mandatory by FASB, and also why the IRS is interested in it in the 990 tax return. Some of the program services, like we said, you kind of have the idea, you can allocate this out. You're required to have your natural classifications, and then you need to allocate them out over your what we call major programs. So this is just something to think about. I know our clients are constantly looking at, your mission is the same, but you may change your programs throughout the year, or not, I'm sorry, not throughout the year, throughout the years. And you may have different programs that you're providing, different names. So you really should think about what are the major programs that we're providing. And those can be separated in your statement of functional expenses into those programs. And some of the things to consider: program objectives, the nature of the services, the magnitude of the program to the overall activities, budget categories. A lot of times you budget that way versus, to like say, what are my major programs that I'm offering? Think about how you're actually budgeting your funds. Some of the management in general expenses, some of the things to think about here, like, again, oversight, business management, general record keeping and payroll, budgeting process, financing, including, allocating interest costs, soliciting funds other than contributions and dues, administrating other types of contracts and such. All these administrative type functions are things that fall into management in general. But we realize, especially in smaller nonprofit organizations, that these functions are often done by the same person. So it's really important to take that person's salary and time and be able to come up with an accurate estimate. And as auditors, that's what we really just look at: the methodologies and assumptions used and the record keeping used for the methodology, because you are now required to disclose these allocation methodologies in your footnotes. So that's really what this is all about. And I'm not going to spend a lot more time talking about the actual functional expense statement, but it's going to tie in directly to what Chris is going to talk about, like a lot of the ratios that we're going to start talking about next. This is a good picture of, down the left-hand side, you see what I was referring to as natural classifications of expenses. And then over the top, you have your program services, and you have, like in this particular example, advisory and training are the two primary programs. And then you go across to management in general and fundraising. But Chris is going to take some time and talk about a lot of these ratios are dependent on the numbers being pulled right off the 990 or the financial statements. of program versus management in general. So it's really important to give a favorable outcome to the organization, to really take a lot of time to think about these allocation methodologies. And what you see here is just a footnote example. You're really required to talk about how you are allocating. So not just that wages are allocated over program and management in general, but how that's done. Is it done on a time and effort study? If you're allocating like rent or office space, like, and the depreciation associated with that, using square footage and other things. So this footnote can get as detailed as needed, and really to help the readers understand how you're allocating. And what we've seen is that it just becomes a more and more important disclosure and tool every year. We think organizations are having more time to think about this now that it's required. And it's something, like we always say, you want to take a look at this every year because things do change. And these ratios that Chris is going to talk about really are important from that aspect. So these are just some other methodology tips and such. But next, Chris is going to talk about liquidity and availability and how all this ties into the financial statements, and particularly the functional expenses that we talked about.
Thank you, Aleisa, and it's good to be with each of you this afternoon. And just a real quick background about my experience here at Mauldin Jenkins. As Aleisa mentioned, I lead not our audit or tax department, but our consulting and advisory services here in Atlanta for nonprofits. And I've had the honor to serve 4 nonprofits as a CFO, as a COO for 20-something years here in Metro Atlanta, and I'm still doing that today under Mauldin Jenkins. And we provide services for organizations who maybe don't need to invest in a full-time CFO or a full-time accounting department, but need bits and pieces of that over time. And so that's how we help nonprofit organizations with being able to carry out their mission in providing administrative, CFO and accounting services support to growing nonprofit organizations. Or maybe you have a CFO and they left and you need temporary help while you find a new one. So we can provide, interim CFO and accounting services too when you're in between full-time staff. Okay, so today we want to talk about what is liquidity, why is it important, and how do you measure it? And first of all, what is liquidity? It's the degree or the ability to convert an asset easily, and that's a key word, into cash. In the real world, how quickly can we get our hands on the cash, right? That's really the definition of liquidity. Examples of liquid assets that are considered highly liquid would be your bank account. It's easy to go, access those funds, a savings account, publicly traded stocks. Examples of non-liquid assets would be things like that beachfront property in Wyoming that you need to sell. That's not easily convertible into cash. So that would be considered a non-liquid asset, or privately held stock. Why is it important for a nonprofit? Well, first of all, and I always like to start with why. It's a book by Simon Sinek. For those of you who don't know, wrote it several years ago. It's a great book, and he says that great organizations start with why they do what they do and not what or how they do. So liquidity is important because first and foremost, it's a measure of financial health. No one wants to fund a sinking ship. If you are a nonprofit and your executive director is constantly out there sending a message that, okay, we got to meet payroll next month, we need your help, we need donations. There's a way to say that doesn't sound like it's a sinking ship, right? And so part of the message here is that liquidity helps you cover those timing gaps between when you need to spend money and when you receive money. And so that's a measure of financial health of your organization. It's your ability, number 2, it's your ability to pay debts as they're incurred and to meet your short-term and long-term obligations, such as if you have a mortgage payment at your nonprofit, or if you have an interest payment that's due, or you lease your facility. As you know, you have to pay that bill every 30 days usually. And so your ability to, the degree to which you can pay that is a measure of liquidity and how easy it is for you to pay that or not pay that. Cash in the bank, in other words. Thirdly, it's important because it helps tell the story of your mission. And I'm going to cover a couple other things first. It's necessary. It's necessary if you rely on government funding. For those of us who were around several years ago when the government shut down, there were many nonprofits who did not receive funding from either state or local or federal authorities for months. And believe me, liquidity mattered greatly at that time because they were expected to still carry out their mission while waiting for the government to reopen and begin issuing checks again. So if you're an organization that is relying heavily on government funding, liquidity is very important too. Another example is liquidity identifies how stressful those timing gaps can be for you. And we're going to talk about a ratio to measure that timing gap in a minute. And I had a colleague once who shared it. So I can't take credit for this quote, but he says, without margin or liquidity, there is no mission. For those of you who are considering new programs or greatly expanding your existing programs, that's a risk, right? And that has financial risk associated with it. And the more liquidity you have in your coffers, the more cash you have in your coffers will help you mitigate the risk of that program's success, or it gives you time for that program to fully evolve and be rolled out. So again, a measure of financial health. So how do we measure liquidity? The first one is a common way that I advise organizations, and that is to think about the number of months or sometimes the number of days of unrestricted cash that you have on hand. How do you calculate it? First of all, you use unrestricted cash, not restricted cash. Remember earlier, Aleisa talked about the importance of identifying grants as unrestricted or restricted. This measure is important to only count what you can access that is unrestricted. And the way you calculate it is you first figure out your average monthly expenses. So if your annual budget in this example is $3.5 million, and you have unrestricted cash on hand of $500,000, on average, you're spending about $3.5 million divided by 12 months, or $292,000 a month in operating expenses. If you have $500,000, then you have enough unrestricted cash on hand for 1.7 months. And that's how you would measure months of unrestricted cash on hand. We all the time get asked, well, how much is enough? How much is enough cash that we keep on hand separate? And we'll be glad to help you structure a very sound liquidity policy for your organization. A lot of factors, I will say, go into that equation. Number one, how much debt do you have? Number two, what are those payments required to be monthly? Number three, are you heavily dependent on government funding? How heavily or not heavily dependent are you on government funding, or any type of funding where the timing between when you spend the money and the timing when you get the money is a long period of time. The lengthier that time, the more liquidity you need, if that makes sense. Okay. Another ratio that's very common, and this one is used by Charity Navigator. For those of you who are not familiar with Charity Navigator is a national rating agency that rates nonprofit organizations. It provides them how many stars they get out of 4 stars. I wish they would use 5 stars, but they don't. They use 4 stars. And whether you want to or not, generally your nonprofit is rated publicly by this Charity Navigator in most cases, and a donor can go to their website and in about 30 seconds can see how many stars are by your organization's name. And believe me, donors make funding decisions based upon how many stars are by your name, which is why these ratios, which go into Charity Navigator's calculations, are very important to your nonprofit organization. I encourage you to study their website, to study how they measure them, and do your own test of how you would shake out in measuring your own ratios. And they break them out by industries. And I've given you an example here of homeless services, but it's something that's very important to your organization to be familiar with, and for your board actually to be familiar with how you're going to get rated by Charity Navigator and similar organizations. And they use the 990 to calculate this. So one of the ratios that they specifically use is called the working capital ratio. And the way that they measure it is very easy. They take your total. It's very similar to the one I just shared with you, except for this one's more of an annual basis. So it takes your, they exclude permanently restricted assets, and they take your net available assets on your 990 and divide it by your total expenses. And that's the working capital ratio. So in this case, the higher, the better. The higher the ratio, the better. And I gave you example of a scoring rubric that they use. If your working capital to liabilities or assets to liabilities ratio is more than 1.0, you're going to get 10 points. If it's 0.2, you're going to get 2.5 points. So that's how they score you on that particular ratio. And they have about, overall, Charity Navigator has about 15 different ratios that they use. And actually, Georgia Center for Nonprofits has a separate class that we actually sometimes teach as well that talks about those ratios in depth and how they're calculated and so forth. All right, the next one is another ratio that's used by Charity Navigator, and that's called financial. I call it financial leverage. They call it liabilities to assets. And basically here what they do is they take very simple definition. They use your 990 that you file, and they take your total liabilities and divide it by your total assets. So in this case, the lower the score, the better, because you want less liabilities, what you owe, over more assets, what you have, basically. And so the lower that is, the better. And so if you wanted to measure that for yourself, you simply take your balance sheet and divide liabilities by assets, and you'll see how you would be scored based upon the industry that you're in. And I gave an example here of homeless service charities. So last year, if your ratio of liabilities to assets was less than 5%, you get their full 10 points. If it was more than 100%, so if your liabilities were $1 million and your assets were $1 million, you get 0 points, because 1 million divided by 1 million is 100%, or 1. I would add, by the way, that some of the, just last week, in fact, December the 1st, so this is very recent, Charity Navigator just adjusted some of their ratios to incorporate some of the FASB updates that Aleisa talked to you about earlier. So they just changed some of the definitions for operating leases, for example, and they're modifying their definitions. So even for those of you who are pretty familiar with Charity Navigator ratios, they're changing. In fact, last week, they just modified the ratio. So you may want to revisit those and see how those ratios are calculated. Last two ratios I'll go over are debt service coverage and operating leverage. And debt service coverage measures how much cash flow you have available to cover your required obligations. Operating leverage takes your operating budget and calculates what percent of that is going to require debt or lease obligations. So for instance, as a service organization, a lot of nonprofits spend somewhere between 50 and 65% of their annual budgets on personnel costs, wages, salary, benefits, retirement, etc. If that same organization is spending, let's say, 60% of their budget on personnel, and 20% or 25% is debt service or lease obligations, that leaves very little left for other types of services in their operating budget. So that's a measure of an organization that has very high operating leverage. So the higher a percentage of debt payments is going to your is a percentage of your operating revenue, the more operating leverage you have, if that makes sense. The lower, the less operating leverage you have. You have more flexibility. Last section, I'm going to just cover this real quickly. You are now required in the accounting updates that Aleisa mentioned to discuss your liquidity, disclose in a footnote to your audited financial statements, both quantitatively, as in calculating it, and qualitatively, as in describing it. And I've given you an example, which you can Google online too, and get an example of how this fictitious nonprofit, if you want to advance the slides there, how this fictitious nonprofit called Save Our Charities discloses their liquidity and availability in their footnotes. And that's the last slide. By the way, on that slide, if we flip one more, Aleisa, that last example, you do have to provide a comparative year. So this example was the first year it came out. And so the Save Our Charities example that's out on the web is only providing 1 year, but you are required to provide a comparative year. So each year you have to disclose these types of this disclosure, which lists, your cash, your accounts receivable, and then in this example, you'll see how this nonprofit describes the types of assets it has and how they access that cash. And it helps the user understand, again, how liquid or not liquid those assets are. We have about 10 minutes left for questions.
Yeah, so thank you for that. And we knew that it was a lot of information for an hour's discussion, but as we mentioned, I think each one of these topics in itself, we are happy to do like a deeper dive into those. I know we've developed some revenue recognition training specifically to help, but like as I mentioned on that revenue recognition, a lot of times it's just helpful to look at those grant agreements, contribution agreements themselves, and then kind of work your way through the guidance. And we're always happy to help with that. The same way with the leases, look at those lease agreements. And then as Chris mentioned, the operating, all the different types of ratios, that's something that we're always happy to help with as well, developing those. It's always, I know the board members really value that kind of information and comparisons and such. So I guess now we're open to discussions. We're happy to answer any questions. I did want to mention Mauldin Jenkins does have a newsletter that we put out. We tried to put out a news brief every month and then a more in-depth discussion quarterly. So if you'd like to be added to that, please reach out to us, email us directly, and we can do that. And then also with your permission through Georgia Center of Nonprofits, we will add you to some of these upcoming events and such. Through the discussion, we're happy to answer any questions, but if we don't get through yours particularly today, just feel free to reach out to Chris or myself and we'll be happy to answer those for you.
Excellent. Okay, so we do have a couple of questions here. Let's start with a pretty straightforward one. Are stock donations considered a gift in kind?
Lisa, why don't you?
Yeah, so basically what that is, I mean, most of the time you're going to have some kind of policy to convert that over to basically cash those in because you're not going to want to hold on necessarily to that stock. So in that case, I mean, you're really getting at the valuation. So you're still going to value that. I think the overall question is, it's something that's donated and you're recording it at the fair market value at the time of donation. So I think that's really to answer the question. So a stock is, of course, is traded on a daily basis. So you would record that, when that actually gets settled into your account for the valuation.
Another example of so what would be example of a gift in kind would be donated rent. So some nonprofit organizations are able to rent office space from, a law firm or, an accounting firm or, some other type of business, and they have free rent for so many months or 6 months or a year. So that will be an example of a gift in kind, donated rent, donated food, donated, any type of donated item, donated food, donated clothing.
Yeah, and it has to be something that you, in order to record it on your financial statement, something that you would otherwise have to pay for or use in your business and the operation. So you want to remember, like, there's a difference between a contribution, like if an organization, for example, let's say you do have a policy that you'll accept old cars. I mean, really what you're doing is, in that case, you're selling it for whatever value and it becomes a contribution versus a gift in kind is something that you're using in your operations that you would otherwise buy. And that's where this idea where you've seen overinflated financial statements, you need to make sure it's in line with what you would have purchased it for and that you actually need it for the use of your business.
Excellent. Okay, we have another one here from Anita. For GIK, so we're going back to sort of the beginning of our presentation here. For GIK, does a detailed schedule have to be maintained to describe the use of GIK materials?
I would say, detailed schedule, like I would say, yes, that you need to be able to support anytime that you have something of material value. So it might be, it might be something that's not material to your organization. As an auditor, that's what we always say, is it material? Is it worth tracking? I mean, I think you've got a couple different issues. One is you want to be able to support what was given, that you would have otherwise bought it, and how it's used in the organization. And then, but the thing to remember is when it's given, it's an automatically offset expense because you would have otherwise purchased that. And then really the other thing too is just, how you're using it, like in operations. That's kind of the non-financial side of it.
So I think, I don't know what Aleisa said, it is important to track, bottom line, yes, if it's germane to your business or your mission. Whether, I think it's important internally and operationally because it helps you tell your story as a nonprofit. If it's a funding source that you would otherwise have to go out and procure, whether it gets on the audit or not, it still might be important as an executive director or, to be able to say that we had, 13,000 volunteer hours, or whether that gets recorded on your financials, which in that case it would not, or not, or we had, we provide food and shelter to 500 people throughout the course of the year. And because of your resources, your generosity, we received, 1 million pounds of donated food to be able to provide to our clients so that they would have, a meal at night. So absolutely, I think it's important operationally to record and understand the use of those gift in kind materials because it helps, if nothing else, it helps you tell your story.
Yeah. And with this new FASB, I mean, the risk there really is that you're overinflating financial statements with valuations of something that you wouldn't have otherwise purchased for the organization or used in the organization. So you do have to remember that, when something's outside the gift in kind, it kind of goes back to the stock question of, is it really a contribution to the organization or is it a gift in kind? And the gift in kind, the treatment's a little bit different because you have the revenue and then the offsetting expense in your financial statements.
Excellent. All right, we have one more here. Are companies moving to preparing the statement of functional expenses, ratio analysis, etc., more often than annual, for example, monthly or quarterly?
I can take it and then I'll let Chris see. Yeah. We're seeing it more and more. It's not the requirement under Financial Accounting Standards Board, of course, is for your external financial reporting, which would be on an annual basis if you're required to have an audit or review. But we're seeing it more and more in monthly or quarterly board packets, just kind of a roll forward of information. But I'll let Chris talk about what he sees and when he's in the outsourced CF role, what they're doing to have ongoing measurement.
I think it's a great question. And it looks like that came from Dan. Dan, that's a great question. I think a very insightful question. And I would say I totally agree with Aleisa. Yes, absolutely, more frequently. I see it more importantly than monthly or quarterly, maybe because it helps the organization define for its funders, for its constituents, for its funding constituents, the real cost of providing these services. So for instance, if you, I'll give you a for instance, if you are allocating, if you're a CEO and it's determined that 30% of your time is directly providing program support, and that's how much of your salary as a CEO of a nonprofit is getting allocated to programs. And it comes time to do a grant and apply for a grant, if you're not aware of that cost, then you might be shorting yourself and talking to the funder about how much does it really cost you to perform that program. By understanding that allocation, you're able to really include the true cost of that program to your funder and actually obtain funding, hopefully, for some of those overhead costs, because they are legitimate costs of your organization. The cost of having an HR director, the cost of having accountants and finance, those are legitimate. IT and information technology, those are all legitimate costs, and being able to understand how those costs are shared in your programs through the allocation is an important, actually, for your development team to be able to appropriately budget in a grant request those costs, if that makes sense. So it's a great question.
All right, so I don't see any more questions. We covered a lot of ground today. Thank you so very much to Chris and Aleisa, excuse me. So thank you all. Thank you, Mauldin Jenkins. You all have just been wonderful partners, providing just really great information and programs to the GCN audience for quite a while now. So we look forward to the next one. And until then, everybody stay